Hi there. Welcome to Options for Stock Traders. So just basic disclosures. This is for educational purposes. This is not investment advice. If I say something, you go do something based on that, and you lose money, it's your fault, is kind of what this says. For those of you who don't know me, my name is Mark Sebastian. I am the founder of OptionPit.com. I also manage a group of hedge funds at a company called Carmen Line Capital. We run a volatility strategy. We're also in the middle of launching a large cap edge strategy. But OptionPit, which is why you are here, is an education and consulting company. We work with individuals and institutions, helping them implement option strategies. So I work with people, teaching them how to use options for trading, to produce profit, income, things like that, in what I deem the most hedged and safe way possible. I'm not a gunslinger. I try and teach people smart, effective ways to trade. I was a floor trader for about a decade on the CBOE. Now, like I said, I am a hedge fund manager, and I am the founder of OptionPit. So, here's the problems with stock trading. Trading stocks is margin intensive. It takes a ton of capital. Investing in stocks ties up tons of capital. The market can lead stocks one way or the other. And it can be hard to tell which way the stock market is going to go throughout the day. Right? Very simple problems. So here's what you're going to learn. All right? How options and stock are interrelated, how to replace stocks in day trading, how to replace stock in investing strategies, an indicator I use for directional trading, more swing trades, and then what I'll do at the end, if you guys are nice, is I'll pull up a couple stocks and of your choosing, and we can look at how to structure a simple directional trade. Sound fun? Great. So options are derivative of stocks, which means without a stock price, you can't get an options price. All right? So this basically means for an option to move, generally speaking, and not always, but generally, the underlying price needs to move. There are exceptions to that rule. Now, how well one instrument moves with another is called correlation. Okay? So for instance, if the amount of hugs I get from my wife is directly correlated to the amount of shoes I buy her. Or the amount of hugs I get from my kid is directly related to the amount of Legos that I get him. They're highly correlated. And that's just kind of the way it is. So options can correlate. Now, there's some ways they can correlate. They can have a delta over 1, but not really. So options can correlate at any number between -1, meaning they are 100% oppositely correlated, negatively correlated. Right? So up is to down is -1. And then they can correlate at 100% of 1, or a correlation of 1, which means they correlate at a level of up is up. Pretty simple. For option traders, how well the option correlates is called its delta. Thus, options can have a delta between -1 and 1. All right, so that's what I mean by delta. All right, option positions that have a positive delta will move with the underlying. So if I have a positive delta, that means that if the underlying goes up, I make money, and if the underlying goes down, I lose money. Options that have a negative delta will move opposite of the underlying price. So if the underlying goes up, my option position will lose money. And if the underlying goes down, my option position will make money. That is a negative delta. Or sometimes you'll hear me use the word long and short delta. A positive delta is also synonymous with long delta. Negative delta is synonymous with short delta. I will use those interchangeably. So take a look here. This is TLT. All right, the Jan 123 calls. Look at that delta. It has a delta of 80.8. All right, now, I just said, wait, delta can be 1 or negative 1. How does this have a delta of 80? All right, well, how in a contract, in an options contract, does anybody know how many shares that represents? How many shares of stock? If I buy one option contract, how many, let's say, if I buy one option call contract in an option, how many shares does that give me the right to buy? Right. So several people have answered 100. That is correct. So that 80 delta is 0.81 or 0.8 times 100. That's how I get to that 80 delta. So TLT, my 123 calls have an 80 delta. The 129 calls have about a 22 delta, about a 0.22 delta. All right. And at the time, TLT was around 126, like it is now, and my delta would be almost 50 right there. 50 is going to be at the money options. That is going to be closest to where the underlying is trading. So the TLT Jan 23 calls have a delta of 80. If TLT moves $1 higher by $1, the 123 calls will make $80 per contract, 80 cents in the options price. All right. If TLT falls $1, the 123 calls will lose 80 cents in their option price. All right. And this is important. Calls have a positive delta, a positive correlation. So if I buy a call, I'm buying positive correlation. If I sell a call, guess what? I'm selling positive correlation. Which means, so selling positive correlation means what? What do you think? Means negative correlation or short delta. Right, so now here's puts. The 127 puts are a 61 delta. All right. Now it doesn't say the negative here, but puts are negative delta. So the TLT Jan 127 puts have a delta of negative 61. For every dollar TLT rallies, the Jan 127 puts will lose about $61, 61 cents in the option price. For every dollar TLT falls, the 127 puts will make $61, 61 cents in the option price. All puts have a negative correlation. All puts have a negative correlation. All right, so meaning that if I buy a put, I'm getting short the underlying, and if I sell a put, I'm selling short exposure, so I'm getting long. All right, so the minimum overnight Reg T margin on a stock is 2 to 1. Some brokers do have better intraday margin, but overnight Reg T is 2 to 1. This means if I buy 1,000 shares of $100 stock, my capital requirement is $50,000 on a swing trade. Right, so I'm putting up 50 grand to get long 1,000 shares of stock. That ties up some decent capital on a 1 or 2 day trade, doesn't it? So the option replacement, and here's the fun part, in buying a heavy delta option, I can replicate the exposure of 1,000 shares of TLT stock using far less capital. So for instance, if I buy 13 of the TLT Jan 123 calls, I can get about 1,000 deltas. All right, that's 1,000 shares of stock. But let's compare the cost. My 123 calls cost $3.30. So let's think about 1,000 shares of TLT. At the time, the stock was 125.77. Times 1,000 times 0.5. My overnight margin on TLT, $62,885. But if I buy my option, if I buy options instead, so I buy 13 options, I'm getting $3.30 times 100 times 13. I'm only putting up $4,300 in margin, guys, for the same exposure. All right, so so the two ways to think about it, all right, so if I make $2 on a swing trade, all right, I'm trying to make $2,000. What would I rather do? Make $2,000 on 62,000 or $2,000 on 43,000, on 4,300? What would you rather do? All right, I say this repeatedly. All right, people who don't trade options, like retail traders that actually day trade, that actually swing trade stocks, are chumps because of the amount of margin they waste. All right. So, and here's the other piece. You know, if I'm tying up $62,000 in one trade, that doesn't give me opportunities to do other trades, does it? What if I see another trade that's pretty good? Guess what? I can trade it because I'm not tying up a ton of capital. I don't understand why people would ever buy stocks in a swing trade. I can kind of get day trading. That makes some sense to me because there's not a lot of margin to it. You know, you can get 4 or 5, 6 to 1 margining. It's almost like options. And in a lot of stocks, the liquidity is better. You know, most options aren't penny wide. Stocks are. So, you know, I can get it on the day trading piece. You know, that said, I still think options are better for day trading, but there are exceptions. I never understand why anybody would ever swing trade a stock. So now choosing the right option. For stock simulation, the 75 to 80 delta is typically going to track the stock well enough that one can use it in day trading or swing trading. You can also go like deep in the money and go 100 delta. That's fine. The only issue with those is they tend to be a little wider. So like here, I'll pull up Apple. And we can look at like October options. So what I want you to notice, all right, so the 80 delta option is 20 cents wide. My 99 delta option right here is about 50 cents wide. So yeah, you can recreate the stock using a deep in the money call, like a really deep in the money call. But I think I like the kind of tighter market of going with kind of an 80 delta. You get the market is significantly tighter, so it becomes easier to trade in and out of. Make sense? Great. So now if one is going to go long, one can buy calls. If one is going to go short, one can buy puts. Or you can add in a little volatility. Volatility can add a second wrinkle to trading. All right, see my YouTube video using volatility to trade for direction. It will significantly change the way you think. That is an entirely, and that's free. It's out there if you go on YouTube. Yeah, here, this one's got about 10,000 views. And it's a pretty nice prezo. It's a little older, and I've got ones that are newer that you can check out. But this is a pretty good presentation. So in short, just the real short one, if volatility is normal or low, buy calls or puts. But if volatility is sky high, I can do a spread. I can sell an 80 delta put or 80 delta call and buy a 5 delta call or put as a hedge or to reduce margin. Okay? So in that case, in the case of Apple, if implied volatility is really, really, really high, well, maybe what I want to do is, and I think Apple's going to go up, maybe I just want to sell a 165 put and buy a a 130 put. And here, I'll show you just the simulation. And what you'll notice is that there is that volatility exposure. So if Apple rallies 4% to 165 and implied volatility falls, I make an extra $400. All right, so now let's talk about long-term investing. In the past, I've showed how short puts and covered calls can enhance the income for stock investors. All right, it's called The Wheel. It's a great, that's another YouTube. If you're riding the wheel with Mark Sebastian, I think you'll like that. The issue is the margin associated with owning stock and shorting a put is still expensive. You get Reg T margining, if you're just naked. So replacing a stock. So rather than executing a covered call, who here does covered calls? Anybody? Long stock, short call. Yeah. So those are nice, but what if I do a synthetic diagonal spread, which is kind of a synthetic cover call? So what I'll do is I'll go buy a longer term option with a heavy delta in the 50 to 70 delta range, and then I'll sell a near term out of the money option with a smaller delta in the 20 to 30 range. I can use monthlies or weeklies. So here's an example. This is one that I did on a show that I used to host called Track the Trade. I bought a 110 call for $450. I sold, this is a long time ago, I sold an Apple December 114 call at 75. It expired worthless. I sold a 126 114 call at 55. It expired worthless. And I sold the January 2nd 115 call at 70. At expiration, or at the time of this, my Jan 110 calls were at $3.65. My 70 puts were worth 9 cents. So that means I made 75 plus 55 plus 60. So that's 110. That's $1.85, and I lost 85 cents. So I made $1 putting up $4.50 in about a month. And you can do these all the time. Here's another one that I did in Facebook. These are older, and I'll show you one that we could do now. We do a lot of these. You know, the whole progression. All right, nice trade. So when do you do these type of strategies? It's a great strategy in just about any environment. While IV might be high in a back month, it will typically be higher in the front. Thus, vol distortions will quickly be covered. One must be watchful of a vol distortion. Don't buy the most expensive month. So, like an example, you know, if you look, you notice like November is actually more expensive than January and more expensive than even April. So I wouldn't want to set it. The sigma means implied overall monthly volatility. So I'd want to set an Amazon trade up in April, and then I would be selling, you know, October in front of it. So it can be great to buy an earnings month or an earnings week and sell the front month in front of it. You know, I love owning the earnings contract and selling stuff in front of it to finance it. And it should be executed when one expects the stock to move slowly. All right. So previously I was right in Apple and wrong in Facebook, but even being wrong in Facebook, Facebook moved. I still made money. So now let me pull up an example of one. Who's got a stock that they like? I can show a Coleman. You got a stock you like? I'll put in a. I'll show you how I might set up the diagonal. Home Depot. I like it. That's a good name. Home Depot. So you can see. All right, I can buy the stock for 160 bucks. So the margin on $160 is going to be 80,000 bucks for 100 shares, right? Or 8,000 on 100 shares. All right, or I can go to 8,000 bucks for 100 shares. That's a lot of money, right? Or I can go to, let's say, January, and I can buy one Home Depot 145 call for $1,680. That's the margin on that is going to be $1,680. Then I can go to the next week, and I can sell the, you know, do you have a covered call on it, or do you just have a just long? So just long, you save yourself a huge amount of margin. But let's say I just want to do the covered right, and I'll just use regular October. I'll use the monthlies. I can get $1 for the 165 call. So my total margin on this is going to be $1,580. And here's the beauty. There's two nice things. Yeah. So here's the beauty here. All right. So I buy my January call. My baby is not happy, huh? You know, I go long, and I'm spending way less. And I can finance it by selling a call, $1 at 165. So if I buy my call, or if I sell my call, and it gets called away, I'm going to make $6. 600. I'll make $600 divided by $1,600 of margin. That's a 37% return. On your long 100 shares, if we run $5, you're going to make $500. your return is going to be 500 over 8,000. That's That's 6.25%. I'm going to go out on a limb and say my trade's better. All right, so now let's just talk about a couple fun scans for directional trading. So this is a scan that I actually have in Live Vol, but this is what I like. I like to find a stock that's right at its 52-week high. I find a stock where the implied volatility is really low, 52-week low. I wait a day. So I wait a day. Then I buy a call that is 1 to 2% out of the money, and I wait a week. That call is going to be killing it. Here's an example. I did an Ulta, like all the way up, and then got out. And then obviously that scan stopped going off, and I haven't been long Ulta since. Find a stock at a 52-week low. Check the 52-week high IV. So if a stock is a 52-week low and the implied volatility is not at a 52-week high, all right, guess what? The stock is going to go lower. Here was one in Macy's where we saw that. And Macy's has since gone here, and now it's at 30. So what we noticed was that it was dropping, and nobody seemed to care. That's a hedge that we like. So I'll look at a couple of trades for you guys, but I want to throw out this offer. So we have a live trading room that we run every day. I throw out 3 really good ideas every day. All right. So kind of we have a strategy letter where we follow along with trades. We have a chat room where myself or a couple of my associates are in every day. We push out 3 decent ideas a morning and then come up with one trade that we really like every couple of days. And it gets and here's the key, all right, it gets all of our special classes. So we do 1 live class a month. All right, right now we do 1 live class a month, and it's a 3-hour class on a subject. So if you go to optionpit.com/direction, this is the class that we're doing right now, a professional approaches to directional option trading. And guess what? The class is tonight, and it's free for people that have Option Pit Live subscriptions. Option Pit Live is $125 a month. I'm offering it to you for $17 for a month, and you can attend tonight's class for free. Other classes that we have done in the past, adjusting positions, managing risk, boot camps, VIX options and futures, creating income, daily options, iron condors, weekly options, commodities, gold, hedging, the VIX primer, the vol primer, calendar spreads, butterflies, condors. Every month we do one of these, and we charge $197 for the class. And if you pay your monthly subscription, you get it. You get it for free. I don't understand why people don't do the subscription. You go to option-pit.live-special-17. Yes, it's a little long. And you can try it for $17. And guess what? If you hate me or you hate our service, you can cancel. Here is the link. Does anybody have any trades they want me to look at? Either as a straight directional trade or as something that I could build around? Any questions? All right. have any ideas, what pop in a stock you want me to look at. Last chance. Otherwise, I will let everybody I'll let everybody go. All right. Have a great afternoon.